Okay, hi there. Welcome to a year 13 micro video. In lessons the other day, we were just going through some of the key objectives of businesses using cost and revenue curve analysis. So I thought I'd share this lesson with you. We focused in particular on three key different business objectives, but also brought into play one or two others as well. And I suppose a key revision point, a key exam point, is that firms have different objectives at different times, and that will influence their price, their output behavior, their investment decisions, so on and so forth. So this is really an attempt to bring together some of the key business objectives using this framework where we have price and cost on the y-axis, output, quantity of output on the x-axis. I'm going to assume in this model that there's a downward sloping average revenue curve, the demand curve, marginal revenue curve, intersects halfway along the x-axis from where the average revenue curve cuts. Marginal revenue, of course, is twice the gradient, half the AR curve. Let me put in a marginal cost curve, the short-term cost of increasing output, and I'll put in an average cost curve. That could be drawn a little better. I'd want the average cost to be intersecting at the minimum point of marginal cost. It's okay. I'll crack on with that. Okay, so three objectives we looked at in the lesson were profit maximization, revenue maximization, and sales maximization. So three maximizing objectives. Let's go through each in turn. Now, hopefully this is revision for you. If you haven't been through this before, then take a moment to go back through your theory of the firm notes in year 13. A firm that aims to maximize profit will choose an output where the price and output combination where the marginal revenue equals the marginal cost. The cost of the next unit produced is just equal to the revenue you get from selling the extra unit. MR equals MC. So we're looking here for the intersection. There it is, between marginal cost and marginal revenue. The profit maximizing price is P1 Q1. And this firm has an average cost there of C1, so that area, that gap between P1 and C1 will be the total profit made by the firm. That's the maximum profit they can make. An alternative objective is to go for revenue maximization. It's a different price, it's a different output. And a firm maximizes their total revenue when the marginal revenue of an extra sale is zero. MR is zero. So let's go back to our marginal revenue curve. Output to Q1 was profit maximization. Can you spot where marginal revenue is zero? It's the intersect between MR and the x-axis. There it is, Q2, output Q2. Draw up to the demand curve. That's the price P2. So if you're revenue maximizing, typically you tend to charge a lower price than if you're profit maximizing. And of course, the revenue maximization point is actually at the midpoint of a linear average revenue curve, a linear demand curve. That's where the price elasticity of demand at that point is equal to 1. You won't get any higher total revenue in that situation. The cost is, okay, so I think that was the original profit, wasn't it? P1 minus C1. I think you can show here that the profit is going to be less than you would be if you were maximizing your profits. Why might firms aim for revenue maximization? Well, some economists, including a very famous economist called Baumol, he argued that a lot of businesses are owned by shareholders but run by managers. They control the business, appointed by shareholders to run the business on a day-to-day basis. And Baumol's research found that things like salaries and bonuses and perks for managers were often closely linked to sales revenue rather than the top level of profit, operating profits. So that was a sort of a managerial explanation for this. There are other plausible explanations. One is that a business is just basically trying to deter the profitable entry of a new firm. So they won't necessarily charge a high profit maximizing price. They may just keep the price a bit lower, earn some extra revenue, and just make it harder for a new firm to break into a market. And another reason is that they want to remain competitive with other firms already in the market. So you might want to be in a situation where you want some extra revenue, maybe to get rid of some stock or perhaps generate some cash in a recession, even in a very competitive market, you probably won't charge a profit maximizing price because you're really competing with other firms in a contestable market. So you'll shave the price a bit and go for revenue rather than pure profit. The third objective is sales maximization. Now we're using maximization 3 times here: profit, revenue, sales. They are 3 different outputs. So sales maximization, which some people call sales revenue max, which is not correct. Sales max is where you choose an output and a price where the unit cost of production just equals the revenue per unit. Average revenue equals average cost. Keep in mind, of course, we build a bit of profit into the cost curve. We have a normal profit included in average cost. So this output there, that is where average cost equals average revenue. So a break-even point in the sense the firm is just making normal profit. And that's the highest output Q3, price P3. It's the highest output they can produce without moving into loss. Can you see that beyond Q3, beyond that point, they would be making a loss because the average cost, AC, lies above the average revenue. So anything above Q3, they'd actually be making a loss overall, or some economists call it subnormal profit. And again, maximizing sales tends to lead to a lower price per unit. Why do businesses choose sales maximization? Well, often firms want to achieve rapid growth of market share. They're looking to turn users into customers. They're looking to build a platform for future success. Okay, they need to break even at least to make normal profit, but perhaps they're willing to accept lower returns in the short term to build up that market power and market dominance, and they could then raise price and make more profit in the long term once they've achieved that. And we kind of discussed in lessons examples of businesses that were maybe not purely, but essentially growth max businesses. I think Amazon over the years has really gone for fast growth, reinvesting operating revenues back into the business, building the economies of scale, logistics capabilities. I think Amazon's a good example of a growth maximizer. Some students mentioned Peloton, which is one of those sports businesses which they make the bikes. In fact, they've been cutting the price of bikes in an attempt to get more people to buy a Peloton bike to use at home, in the home gym maybe. And once they've got a bike, then you can flog them the subscription services and the home exercise classes. Peloton is a very fast growing business. So too Zoom, of course. Many of you will have had online lessons using Zoom or Microsoft Teams during the pandemic. We thought that Uber was probably a decent example of a growth maximizing firm, aiming to really grow their market share in many cities around the world. Although there was an argument that Uber's surge pricing, they use of course those price algorithms to increase the fares at peak times. The argument was made by a student that surge pricing actually represents a move certainly towards revenue maximization and perhaps even more towards profit max. My argument, my example was the Poundlands, the Aldi's and Lidl's of this world. Very fast growing businesses, the deep discount food retailers who are really trying to take on the established giants such as Morrison's and Sainsbury's, Asda and others. So those are our 3 objectives. Now you can't go wrong if you understand and know that businesses have different objectives, and that will lead to different prices and outputs. Profit max, revenue max, sales max. If you get those 3, you're in great shape. We just thought a little bit about 3 other objectives. Increasingly, businesses are, and there is now legal requirements for businesses to have, if you like, statutory corporate social responsibility. That's when companies integrate social and environmental concerns into their business operations and their interaction with a wide variety of stakeholders. So, there are good reasons for embracing CSR, being a good citizen, customer-related motivation. It's good for attracting customers and positioning the brand, cutting costs by being more sustainable on packaging and energy usage, for example. So there's a lot of interest in CSR. Increasingly, of course, businesses may have a government as a stakeholder, as a shareholder. So public service businesses may have some degree of political, commercial targets set by the government. And something called satisficing. I just want to finish my video with the idea of satisficing. This is really important. Satisficing is a move away from maximizing behavior. So satisficing is basically saying a business will choose a price and an output where they make a satisfactory and sufficient profit, but not necessarily the maximum profit. Enough to meet the competing demands of shareholders, the stock market, and other stakeholders in the firm. That's what we call satisficing. Now, profit satisficing has no unique price and output combination. So let's go back finally to our previous diagram where we had three different objectives: profit, revenue and sales max, and that gave us three different outputs: Q1, Q2, Q3. Well, there is no unique satisficing price and output combination. There's a range. You probably don't go beyond Q3 because you want to make it at least break even. You may not go much to the left of Q1 because you'll be sacrificing profits. An example of satisficing would be this combination: price P4, output Q4. It's a little lower than profit maximisation. It's a little less than revenue max. But if that's the average cost, you can still make a tidy profit, but the total profit won't be as high as if you try to maximise your profits. That's what's called a satisficing objective, and it's definitely something to have in your notes ahead of the micro exam. Okay, thanks for working through this with me, and I hope that that made some sense. Cheers now, take care.